And I'd like to understand from you your thought process about the securitization currently, the future, and how do you think that this will change the overall dynamics of the this new regulation and the tightening of the norms also will help in the overall growth of the portfolio, or it will reduce the portfolio growth in the securitization, or what are the risk factors which are there in the overall securitization which you perceive or which you see in the current scenario, sir?
We must understand that in India, particularly, regulation plays a very important role in the way the business develops. And this is seen right since the RBI brought the first set of guidelines in 2006. 2006, as you might recollect, the first set of RBI guidelines came that dealt with securitization only. It did not cover direct assignments at all. And therefore, the easy route for people was to pick up a direct assignment window, not to do a securitization, go for a direct assignment. And therefore, the entire market shifted to so-called direct assignments. In 2012, after the global financial crisis, RBI tightened the rules and covered direct assignments as well. There, people had a choice to go for securitization or to go for a direct assignment. But in the meantime, there was a taxation issue. In 2021, as the RBI came with the new so-called SSA directions, which separately split the regulatory framework for transfer of loan exposures and one separate direction for the transfer of for securitization of standard assets. Now, of course, in 2025, the RBI has done a major consolidation exercise where all regulations have now once again been consolidated entity-wise, and therefore there is a new set of transfer and distribution of credit risk (TDCR) regulations. One set for commercial banks, one set for NBFCs, one set for AIFIs, one set for SMBs, and so on. So there's a major consolidation come subdivision exercise by the RBI. I would surely like to talk about at least two very significant regulatory changes. Of course, in terms of market dynamics, we'll talk subsequently. But two major regulatory changes. Number one, the change of co-lending directions. Ashish Ji himself in his presentation talked about the new co-lending framework, which is supposedly becoming mandatory from 1st of January. Earlier, people were expecting there'll be some kind of deferral. I don't think, frankly, there's any deferral. Might be reasonable to expect a deferral at this stage. In fact, several companies have already started pre-implementing the new co-lending directions. So what the new co-lending directions do is that earlier people were taking co-lending as the very simple route to avoid DL direct assignment because co-lending used to be, I mean, much easier as there is no minimum holding period required. One could probably also think of some bit of credit support in co-lending transactions. So people were using co-lending as a simpler route out of deal. Now that co-lending itself has a significantly changed framework. There is a credit support possible, but up to a limit of 5%. The minimum risk retention is brought down to 10%. However, it's also clear that you cannot do a so-called discretionary co-lending because the loans have to be mandatorily picked up by the co-lending partner once they are originated. There's a 15-day operational time period. That's more for operational convenience, not for the exercise of discretion by the co-lender to buy or not buy the loans. So that's a major change, and therefore people would once again come back and discuss whether if I'm actually wanting the benefit of hindsight, if I'm actually wanting to pick up those loans which I want to pick up, I would rather go for a direct assignment because if I go for co-lending, I'm bound to take the loans which have been originated by the co-lending partner. Originating partner has originated loans, I'm bound to take it. If I want to test and then select what loans will I want to pick up, then I would rather go for a direct assignment. So I think there is a very compulsive reason to relook at direct assignment post 1st of January. This is a new set of regulation which the RBI brought on the 5th of December. It's called Financial Services Directions. Of course, commercial banks, financial services directions. What it actually goes to say is that if there is a bank and there is an NBFC also in the part of the banking group, this is basically directed towards banking group. And I'm sure everyone would agree that in India, most of the commercial banks also have other entities. For example, a bank has an NBFC, a bank has a securities trading company, a bank has an operating entity, etc. Banks have various so-called group entities. If the bank has a There's a banking entity and there's a non-banking financial company. The bank is supposed to make a board level choice of what product will be offered by the bank departmentally and what product will be offered by the NBFC. Therefore, the bank decides, for example, vehicle loans will be offered by NBFC and not by my bank. Home loans will be offered, say, by an HFC, not by the bank. LAP loans will be offered, let's say, by the bank, but not by the NBFC. So the bank has to decide which product will be offered by which entity. Once the bank has made the choice, it becomes a board level sort of allocation of businesses. Assuming that the bank decided that vehicle loans will be offered at NBFC level or home loans will be offered at HFC level, then is it possible for the bank to then buy that portfolio by a direct assignment window? If the bank had chosen that we will not do home loans will be done by an HFC of the banking group, then the option of buying the loans also subsequently would not remain because that's a board level, I would sort of broader allocation of business. And therefore, to my mind, the only route for the bank to therefore acquire a stake in the home loan or vehicle loan portfolio will be to invest in pass-through certificates because D option will get ruled out. Co-lending also will get ruled out because the bank has made a choice that we will stick to, for example, commercial loans, vehicle loans will be done by the NBFC, home loans will be done by an HFC, etc. Then the only way for the bank to, I mean, kind of acquire portfolios originated by those group entities will be through a direct assignment, will be through a PTC route, neither by direct assignment nor by co-lending.